In this lecture, which is titled as The Bond Market, we are going to explain the following. First, purpose of the capital market. Second, capital market participants. Third, capital market trading. Fourth, definition and types of bonds. Fifth, corporate bonds. Purpose of the capital market. Money markets are for securities with an original maturity of less than 1 year. For example, commercial papers. Capital markets are for securities with an original maturity that is greater than 1 year. These securities include bonds, stocks, and mortgages. Firms that issue capital market securities and the investors who buy them have very different motivations than those who operate in the money markets. Also, firms and individuals use the money markets primarily to warehouse funds for short periods of time until a more important need or a more productive use for the funds arises. By contrast, firms and individuals use the capital markets for long-term investments. Capital market participants. The primary issuers of capital market securities are governments and corporations. Also, the government issues long-term notes and bonds to fund the national debt and to finance capital projects such as school and prison construction. Note that governments never issue stock because they cannot sell ownership claims. Corporations issue both bonds and stock. One of the most difficult decisions a firm faces can be whether it should finance its growth with debt or equity. The distribution of a firm's capital between debt and equity is called its capital structure. Corporations may enter the capital markets because, first, they don't have sufficient capital to fund their investment opportunities. Second, they want to preserve their capital to protect against unexpected needs. Third, the availability of efficiently functioning capital markets is crucial to the continued health of the business sector. Capital market trading. Capital market trading occurs in either the primary market or the secondary market. The primary market is when new issues of stocks and bonds are introduced. When firms sell securities for the very first time, the issue is an initial public offering. Subsequent sales of firms' new stocks or bonds to the public are simply primary market transactions, as opposed to an initial one. The capital markets have well-developed secondary markets. A secondary market is where the sale of previously issued securities takes place. Secondary markets are critical in capital markets because most investors plan to sell long-term bonds at some point before they mature. There are two types of exchanges in the secondary market for capital securities. The first one is organized exchanges, and the second one is over-the-counter exchanges, of course. Definition and types of bonds. Bonds are securities that represent a debt owed by the issuer to the investor. Bonds also obligate the issuer to pay a specified amount at a given date, generally with periodic interest payments. Note that the par, face, or maturity value of the bond, they all mean the same thing. It's the amount that the issuer must pay at maturity. The coupon rate is the rate of interest that the issuer must pay, and this periodic interest payment is often called the coupon payment. Also, this rate is usually fixed with the duration of the bond and doesn't fluctuate with market interest rates. Note that if the repayment terms of a bond are not met, the holder of a bond has a claim on the assets of the issuer. Also, long-term bonds traded in the capital market include long-term government notes and bonds, municipal bonds, and corporate bonds. The picture you see explains corporate bond. Corporate bonds. When large corporations need to borrow funds for long periods of time, they may issue bonds. Most corporate bonds have a face value of $1,000 and pay interest semi-annually, which means twice per year. Most corporate bonds are callable, meaning that the issuer may redeem the bonds prior to maturity after a specified date. The bond indenture is a contract that states the lender's rights and the privileges and the borrower's obligations. Any collateral offered as a security to the bondholders is also described in the indenture. The degree of risk varies widely among different bond issues because the risk of default depends on the company's health, which can be affected by a number of variables. Also, the interest rate on corporate bonds varies with the level of risk. The bonds with lower risk and a higher rating, for example, AAAs, being the highest, of course, have lower interest rates than more risky bonds. For example, its rate is BBB. Characteristics of corporate bonds. First, restrictive covenants. Since bondholders cannot look to managers for protection when the firm gets into a problem, they must impose rules and restrictions on managers designed to protect the bondholders' interests. These are known as restrictive covenants. They usually limit the amount of dividends the firm can pay, of course, to conserve cash for interest payments to bondholders. And they usually limit the ability of the firm to issue additional debt. Restrictive covenants are included in the bond indenture. Typically, the interest rate is lower the more restrictions are placed on management through these covenants, because the bonds will be considered safer by investors. Second, call provisions. Most corporate indentures include a call provision, which states that the issuer has the right to force the holder to sell the bond back. The call provision usually requires a waiting period between the time the bond is initially issued and the time when it can be called. Also, the price bondholders are paid for the bond is usually set at the bond's par price or slightly higher, usually by 1 year's interest cost. For example, a 10% coupon rate, $1,000 bond may have a call price of $1,100. Third, conversion. Some bonds can be converted into shares of common stock. This feature permits bondholders to share in the firm's good fortunes if the stock price rises. Also, issuing convertible bonds is one way firms avoid sending a negative signal to the market. Types of corporate bonds. First, secured bonds. Secured bonds are ones with collateral attached. Mortgage bonds are used to finance a specific project. For example, a building may be the collateral for bonds issued for its construction. In the event that the firm fails to make payments as promised, mortgage bondholders have the right to liquidate the property in order to be paid. Note that because these bonds have a specific property pledged as collateral, they are less risky than comparable unsecured bonds. As a result, they will have a lower interest rate. Also, equipment trust certificates are bonds secured by tangible non-real estate property, such as heavy equipment and airplanes. Typically, the collateral backing these bonds is more easily marketed than the real property backing mortgage bonds. As with mortgage bonds, the presence of collateral reduces the risk of the bonds and so lowers their interest rates. Unsecured bonds. Debentures are long-term unsecured bonds that are backed only by general credit worthiness of the issuer. Also, no specific collateral is pledged to repay the debt. So, In the event of default, the bondholders must go to court to seize assets. Also, debentures have lower priority than secured bonds if the firm defaults. As a result, they will have a higher interest rate than the otherwise comparable secured bonds. Subordinated debentures are similar to debentures except that they have a lower priority claim. This means that in the event of a default, subordinated debenture holders are paid only after non-subordinated bondholders have been paid in full. As a result, subordinated debenture holders are at greater risk of loss. Variable rate bonds, which may be secured or unsecured, are a financial innovation spurred by increased interest rate variability in the 1980s and 1990s. The interest rate on these securities is tied to another market interest rate, such as the rate on treasury bonds, and is adjusted periodically. The interest rate on the bonds will change over time as market rates change.